SpaceX has officially filed its paperwork to go public on the US stock market, and this is going to be the biggest IPO in history. It's going to be a $2 trillion company, but with $5 billion in losses. We're going to break down what an IPO actually is, what you'd be buying, and more crucially, how you can invest if you want in. We're also going to be covering Elon Musk and his lawsuit on OpenAI, which did not go his way. Shakira just won a €55 million tax battle with the Spanish government, and surprisingly, there are some genuinely useful takeaways that could apply to you. And finally, the impact of AI on the jobs market. There is much more to this than meets the eye. We discuss what industries are going to stand the test of time and how you can position yourself well. This is The Curve Weekly, where we read the finance news so you don't have to. I'm Vic Harris, a finance professional who's had a career making money for other people. And my co-founder, Sophie, is on holiday with her boyfriend, so I am flying solo today. Huge thanks to Emily Rigby, our producer, and Lucy Munro, our fab social media manager, and the rest of the Curve team behind the scenes. But before we dive into the headlines, here is a word from today's sponsor. This episode of The Curve Weekly is made possible by Pathfinder KiwiSaver Plan, helping you invest alongside your values.
Pathfinder's won Mindful Money Best Ethical Investing Provider for 5 years running, so we've teamed up with them to bring you the Ethical Hotline.
Got questions about the ethics of an investment or unsure where you draw the line?
Submit your questions via the link in the podcast show notes, and thank you so much to Pathfinder for making this episode of The Curve Weekly possible. Pathfinder Asset Management Limited is the issuer of the Pathfinder KiwiSaver Plan. A product disclosure statement is available at pathfinder.kiwi.
So we have some very exciting news. SpaceX has officially filed for IPO. Now, IPO, remember, is the first time that a company has its shares available to the public. So it goes from being a private company to a public company where you and I can buy shares, which is awesome. It is going to list on the NASDAQ, and the NASDAQ is one of the US stock exchanges. So we've got the NASDAQ and we've got the New York Stock Exchange. They're kind of like competitors. On the NASDAQ, it's mainly more tech companies. So it's Amazon, Apple, Google, Meta. It's got all the big names we know. So yeah, SpaceX is kind of following suit and going on that exchange. This is going to be the biggest IPO ever. The company is going to be valued at $2 trillion. So we have never, ever seen a company come to market that is that big. And just to put that in context, when Facebook first went public in 2012, it was valued at $100 billion. And now SpaceX is coming at $2 trillion. Amazon is a $3 trillion company. Microsoft's a $3 trillion company. So just to put that in perspective, they've been public companies for like so long now. Not only that, they're highly profitable. They've got a proven track record. And you now have a company coming to market for the first time, and it's got none of that. It hasn't got a track record. It hasn't got like the history. It hasn't been traded on the stock exchange for years, yet it's somehow thinks that it should be like at the same level as all these other companies. So anyway, this is why it's got so much interest. I mean, its revenue is $20 billion last year, but it lost $5 billion. So it is loss-making. I mean, Uber was loss-making when it IPO'd for the first time. It was absolutely heavily criticized for it. But for some reason, people are giving SpaceX a lot of time. There's a lot of excitement and a lot of euphoria around it. But for those of you who don't know what SpaceX is, like, it's not just a rocket company. So SpaceX owns Starlink. Starlink is the kind of satellite company that has about 10 million subscribers globally. It also includes xAI, which is Elon Musk's AI company. So you've got a satellite company, you've got an AI company, and also in there is X, which used to be Twitter. So you've got kind of three businesses, one in kind of satellites, one in AI, one in media. Like all of those combined together is what has created that value of $2 trillion. So it's really a company that investors are betting on the future, you know, particularly with AI, satellites, all of that. But this is where it gets interesting. So Elon Musk, he is going to control 85% of this company. If you are not in alignment with what he wants to do, then I guess you shouldn't be buying this company. But it also goes to show that shareholders are going to have very, very little say in how this company is run. It is very much going to be the Musk show. I guess it is similar to how Mark Zuckerberg ran Meta. He was very much a dominant force, very much the leader. It's how Google has actually structured the two Google founders have structured Google and Alphabet shares. So it's kind of, there's a lot of protections in it to protect the founder, but personally I like investing alongside founders, not necessarily Elon Musk, but there are some I like investing alongside more than others. Founders are very visionary, they're very driven, they're very long-term thinking, and that's what I like when I look for an investment. But this IPO in SpaceX could make Elon Musk the first trillionaire, the first person to have $1 trillion in wealth. I mean, I can't even believe that we're speaking about $1 trillion companies, a $1 trillion IPO. If you'd kind of mentioned that to me 10 years ago, even when we didn't even have $1 trillion sized business, and now we've got so many, and now we've got an IPO coming in at $2 trillion. Yeah, it's wild, wild, wild. Now, there's actually a part of this IPO which I don't know if it's crazy. I don't know if it's amazing. There is kind of, I guess, a pay package or a bonus structure that has been created for Elon Musk that's tied to this IPO on top of his existing stake of around 5 billion shares. So that's around $700 billion that he will have created in value when he IPOs this business. On top of that, the board of SpaceX has granted him an additional billion shares if he hits certain targets. And one of those targets, I'm laughing because it is so crazy, is tied to colonizing Mars, putting people on Mars, and also building data centers in space. The Mars bonus is he will be awarded 200 million shares if SpaceX hits a valuation of $7.5 trillion. So remember, it's IPOing at $2 trillion. So if it hits $7.5 trillion in size, which is bigger than any existing company ever, and he successfully establishes a colony on Mars of at least 1 million people, he gets this bonus. So it's not just one person on Mars. There has to be 1 million people living on Mars for Elon Musk to get this bonus of 1 billion shares. There is no time frame on this. So if he does this in, I don't know, in 50 years' time, when he's old and decrepit and, 100 or 120 years old, he'll get paid this. But he has had some pretty impressive bonus structures that have been tied to Tesla, and he's hit them, and he's got these incredible payouts. When I read this, I was like, that's absolutely crazy. But now I'm actually like, you know what? If there's any person that could do it on this planet and could actually create a new planet that we civilize, is probably Elon Musk. Nothing would be more motivating than 1 billion shares in SpaceX. So anyway, we'll see how it plays out. But even if he got the valuation of SpaceX to $7.5 trillion and he only had 900,000 people living on Mars, he wouldn't get a payout. He has to reach both of those milestones, but no time frame. So he just has to be employed still by SpaceX. So very, very interesting bonus structure, something I've never, ever seen before. If it comes to fruition, I think our world is going to look so weird and so different. And the fact that we're going to have little humans running around on Mars, yeah, it's kind of absolutely crazy. But this will be probably one of the most hotly debated IPOs, I think, in a generation. I think it's anything that I've seen. The ambition is just insane from Elon Musk and what the company's trying to achieve. People that are really positive on it are like, you know what, there's Starlink, which is hugely profitable. SpaceX is dominating in rocket launching, and there is kind of this generational infrastructure they're trying to create with data centers on Mars. It'd be like buying Amazon 25 years ago. Nobody believed what they were going to do, and they've absolutely transformed that business from selling books online to having one of the world's biggest logistics networks in the world, being one of the largest cloud providers. All of that is like never, ever in a wildest dreams would you have seen that 25 years ago. So we could be sitting here, maybe listening to this podcast in 25 years, and we've got people walking around on Mars, and Elon Musk is walking away with 1 billion in shares. I guess the negative side of this, people are like, the valuation, so what this company is being priced at, which is the $2 trillion, is 100 times its annual revenue. So you are paying 100 times the revenue this business is creating to come up with that value for the whole business. And this is how most businesses are valued, is it's a kind of like a multiple of either profit or revenue. And so just to kind of put it in perspective, like if we think of Apple is trading at 11 times its revenue in terms of the size of the business. NVIDIA, the AI chip company, is trading at 25 times, and we've got this business that has never been public, no track record, that's coming in at 100 times. So anyway, there's a lot of people on the positive side, a lot of people on the negative side. It's pretty divisive, to be honest. If you do want to invest in this IPO, the great thing about this IPO is that Elon Musk, for all his sins, he has actually, with this IPO, carved out a really large chunk for retail investors. And retail means just kind of like you and me, mum and dad investors. And a lot of IPOs go to institutional clients. So think like fund managers or KiwiSaver or pension providers or wealthy clients. And Elon Musk has gone, you know what? No, I want, the everyday investor to have a large portion of this IPO. So 23 billion of the 75 billion that they're kind of raising for IPO is going to go towards retail investors, which is great. It's about 30% of the IPO. So if you are on a trading platform like Sharesies or Trading 212 in the UK, Stake in Australia, like keep an eye out. There could be a notification if you want to access this IPO and actually buy shares in it. Just remember, IPOs in general are very risky. Like they haven't had a track record. They haven't made their finances public. They don't have to. So, and also with this kind of IPO, there's a lot of hype. We saw what happened to Allbirds. Not saying that this is going to go the same way. I have no idea. But just something to be aware of is that sometimes there is better opportunities to buy shares in a company, not at IPO. It might be a year later or once it's kind of got over the hype. Personally, I really like what is happening in the space industry, and the fact that we're seeing data centers in space, like satellites and more commercial trips to space. I think it's a huge trend. It's going to get more and more interest. We've got Rocket Lab, which has done fantastically well. I think the big caveat with this one is just the kind of ridiculousness associated with it in terms of the valuation, in terms of the fact that it is just a huge, huge company coming in at such a high price. And Elon Musk's bonus structure, it's kind of taking the piss a bit, I think. But that is my opinion. But the whole space, I do love. And it is, I think, a long-term trend that's going to be here for a while. So, yeah, I do like this space. Just to continue on the theme of Elon Musk. So I think it was earlier this year, we spoke about Elon Musk suing OpenAI, which owns ChatGPT. I remember Soph saying something like, I think this is going to be the new Netflix series. And we were getting all excited that it might be like the Netflix, Warner Brothers, Paramount drama, and it'll be something that we'd talk about in each Curve Weekly. Well, sorry, it's well and truly been shut down. A bit of the background. So back in 2015, Elon Musk actually co-founded OpenAI, so ChatGPT. It was started as a not-for-profit. So it was the idea that something so powerful as AI should benefit the whole of humanity, not shareholders. And so it was kind of founded on that premise, the mission, and that's what people got on board with, and that's what Elon Musk got on board with, which is surprising. Anyway, he donated, because you can't invest. So he essentially donated millions to the company. There was a bit of a power struggle between becoming CEOs and all of that. Anyway, he left in 2018. So started in 2015. He left 3 years later. At that point, OpenAI converted from a not-for-profit to become a for-profit company. Elon Musk was absolutely furious, and that's what he is suing for. Now, he was suing for, I think it was 134 billion in damages. He wanted to remove Sam Altman, who is the CEO and founder of OpenAI, and he wanted to reverse the business from a for-profit to a not-for-profit. So kind of back to what it originally was. They were in court, and within 2 hours, the judge was like, this case is kind of dismissed. They unanimously decided that the claims that Elon Musk was making effectively was beyond the statute of limitations. Now, I was like, what is that? That just means it took him too long to bring this case to court. So if he'd done it maybe 5 years earlier, he probably could have actually had a case, but they were like, oh, you've waited way too long. And also the company that is OpenAI now is now worth billions of dollars. And so no wonder he's pissed off, and now he's claiming these, huge losses. So they're just like, you know what, you took too long. Elon Musk said he's going to appeal, but essentially it's a non-event. So apologies, there is no Netflix series coming out of this about Elon Musk and Sam Altman kind of going at it for years. But one interesting thing that actually came out of the court case, which is kind of embarrassing for Elon Musk, is that he wanted OpenAI to be a for-profit company. And so this is all becoming like, well, hang on a second, you wanted it to be a for-profit company and you actually have said in emails that you wanted to become CEO. So this is just a complete power struggle of two men who have these dominating AI businesses. Anyway, it's probably a good thing. It allows now for SpaceX to kind of have its time in the sun in terms of being a new public company. And they've also actually got OpenAI, which is going to become public soon, probably this year. Haven't given any dates yet, but yeah, both founders can just swan off into the sun and just focus on growing their businesses. Coming up after the break, we talk about a lawsuit that Shakira has filed and actually won. But before we dig into that, here is a note from today's sponsor.
I invest so much more now, but I still don't feel great about profiting from companies that I don't believe in. You know, weapons. I personally do not want to be making money from conflict.
But what about weapons companies that supply like both sides of the conflict? Pretty confusing, right?
I know, it's so confusing, and I feel like I'm not alone in that.
Yeah, I mean, 80% of New Zealand investors don't want weapons in their KiwiSaver, yet Mindful Money reports that over $400 million is still invested in weapons manufacturers, which is why choosing the right provider matters, like Pathfinder KiwiSaver plan, which aims to avoid profiting from conflict.
They've been recognised as weapons free by Mindful Money and written loads of blogs on this topic, even covering their position on Gaza, which a lot of people have avoided. So if you want to check out our podcast show notes to learn more, and thanks so much to Pathfinder for making this episode of the Curve Weekly possible. Pathfinder Asset Management Limited is the issuer of the Pathfinder KiwiSaver plan. A product disclosure statement is available at pathfinder.kiwi.
Now, look, for many people who have listened here for a while, you will know that I hate talking about tax. And anytime we get asked a tax question, I just avoid it like the plague. It is so personal and everyone's situation is different. And so when we get questions about what amount of tax should I pay, or should I pay tax, or where do I pay tax, like it totally depends on your personal situation. But this headline sparked my interest because it said Shakira wins a 55 million euro tax battle. And I was like, oh my goodness, like that's a lot of tax. The context of this. So she had been in a relationship with a Barcelona footballer, so a very high profile Barcelona footballer. So naturally had spent a bit of time in Spain. And the Spanish tax authorities actually claimed this made her a tax resident. This is way back in 2011. So she's been fighting since then, and she's just won this. But they claimed that she was a tax resident because she'd been dating this Barcelona football player. And therefore, she was liable to pay Spanish tax on worldwide income. So some countries, you only pay it on your income that you are a tax resident for. Other countries, you have to pay it on your worldwide income. Like in the US, you have to pay, if I lived here in the UK, but I had a US passport, for example, then, I might have to pay it on my worldwide income. So anyway, this is what was going down with Shakira. This week, a Spanish high court overruled that decision and said that the tax agency had failed to prove its claims. And part of this, which seems so obvious, is like the Spanish tax agency had failed to prove that she had spent 183 days in the country in 2011. So one of the biggest things that claim that you're a tax resident if you spend more than 183 days in that country. And like I remember with Soph and I, when we were kind of going back and forth between the UK and New Zealand, I had to prove that in order to be a tax resident in New Zealand, that I'd spent more than 183 days there. So like this is kind of a bit of a common thread with a lot of countries is this threshold. And anyway, her defense was that it is materially impossible for her to have spent more than half a year in Spain because she was on a world tour. So she had performed 120 concerts in 37 countries. And she was like, that just completely shows that I could not have spent more than 183 days in Spain. Anyway, it was overturned. The tax agency in Spain has to pay her 55 million euros plus interest. I think the takeaway for me from this was that if you are, I guess, in between countries or kind of doing your tax, one thing that you should always do if you're not in a salary job and, it's kind of all done for you is make sure that you keep all your receipts. I know it sounds really, really basic, but like document everything. Keep your receipts, have a diary, or at least note down if it's digitally or, in a notepad or something, like the days that you're in each country, and like just make sure that you document, keep your boarding passes, all of that, just even if it's, physical or online, because you'll never know. And I remember having to scour through, like old boarding passes and, trying to figure out what days I entered and what days I did. And it was actually really cumbersome. So if you are in a position where you're working in different countries, just make sure that you document everything. Also, it's where you actually live, not where your partner lives. It's all about you. And there's other things like if you own a house or if you have family in that country. So there's lots of different things, but that's a bit of a learning from Shakira. So yeah, thanks. Now, we had a podcast a while ago about how we think that AI is actually going to create more jobs, not destroy them. But there's been a bit of an alarming economic stat that's come out last week, and it's all around jobs that have been created in the US. Now, people look at this kind of statistic quite closely because it does show like the health of an economy. And in the US, the jobs data came out last week for April, and it showed that there was 115,000 jobs that were created, which is great news. And this is 2 months now of gains in jobs. So really, really positive to see 2 months of growth. But if we dig under the surface, there's actually some real warning signs. And firstly is that number of jobs that jobs growth was dominated by healthcare. And we need to kind of strip healthcare out because it's always going to grow. There's always going to be jobs. It's because people always get sick. We've got an aging population. There's always a need for it. So it's quite recession proof. Yeah, 30% of all those new jobs were created in the healthcare space. So if we strip that out and you take healthcare out of the equation, the US economy is actually losing jobs. So it's losing more jobs than it's gaining. So it's like a net negative. So it might have added some, but it's lost more. So like overall, it's lost jobs. And the predominant places are in government because there's massive government cuts right now, government spending cuts. So they're not hiring, they're not creating new jobs. But it's also in finance, tech, and IT were the next biggest, sectors of job cuts. US employers across the board announced the third highest monthly cuts since the 2008 financial crisis. That's quite massive. And that just shows, I guess, the uncertainty that employers and businesses are facing now. And this is not only in the US. We're seeing this across the board. We're seeing this in the UK. We're seeing this in New Zealand. Less so in Australia, but we are seeing it across the board. And even speaking to friends who are unfortunately being made redundant and trying to find new jobs, or in the job market, young people are really struggling to find jobs at the moment. And it's because when there's a lot of uncertainty in the world, it makes it harder for businesses to make decisions. So even just taking the curve, for example, if we didn't really know what was going to happen in the future, and, of course you don't to a degree, but if you were trying to make decisions about growth and whether to go into this market or launch this product, and you couldn't make those decisions because you didn't know what the world was going to be, then of course you're not going to be hiring people either. So everything that's going on in Iran, the oil price, inflation, all of those things that are going on in the world right now have made it really hard for businesses to grow and therefore hire. And then you throw on top of that AI. It's not quite what you think. It's not a case of robots replacing people overnight. It's definitely not that. But companies are kind of cutting divisions or cutting costs in certain areas so they can redirect that money into AI. So they're instead of spending over here on maybe hiring in HR and operations or whatever, we're going to spend on AI. So there's not new jobs being created. It's either jobs being cut due to AI or status quo. We're just not going to hire anyone. We're going to make people more efficient by using AI. But I just want to say it's kind of like a reallocation of resources. It's not a kind of mass automation and we're going to see, waves of people lose their jobs. Yes, in the short term right now we're seeing this, but over the long term, I genuinely believe that this is going to create so much more opportunity and growth and so many more jobs in the long run. But when we do see these big changes, evolutions, revolutions going on in the world, there's almost a bit of a digestion period as people rejig to, I guess, get the kind of correct foundations and then invest and grow again. Also, if you are looking for a job right now and you are feeling disheartened and, it is tough, don't get me wrong, but just remember this is a cycle that is happening. It's not because of you. And I think the best thing that you can do is look at how you can upskill and maybe incorporate AI a bit more into your CV and into your experience and your talent. So therefore, you're more likely to get hired. But also, think of the jobs that are going to be around in 10, 20 years' time, or where the growth is going to be, and how can you position yourself to be part of that. And I think that's for me, the really exciting part is, always looking into the future of being like, okay, where is the growth? Not only from an investment standpoint, but obviously from you personally as a little asset and as an investment. How can you upskill so that you can grow with those jobs and with the movement of the world right now and where it's heading, rather than being left behind. Speaking of jobs, we have one available at the Curve. It is a junior editor role and it is based in London. It's full-time and you get to work with the amazing Curve team. If you're interested, we'll put the link in the podcast show notes. But the applications close on the 30th of May. Yeah, just Emily's just telling me it's the 30th of May. Yeah. Now we have our community question, which I love these. And it says, when people say they're getting an income from their investments, i.e. being able to retire because of investing, are they selling their stocks to generate income, or is this from dividends? Really good question. Look, it completely depends. Some people do both. So some people might sell their stocks. Some of them might just live off the dividends. It completely is up to their own situation. So firstly, someone might live off the dividends. So that just means that they're getting paid for owning the shares. So if you think of maybe a property, and you rent that out and you get rental income, it's exactly the same. A dividend, when you own a share, you get paid some of the profit. So that's kind of what a dividend is. If you have a large enough sum, you can actually generate a pretty livable income off your shares that give you dividends. Let's use an example. If we had someone called Sarah who, say she owned 500,000 by the time she retired in a dividend paying fund or in stocks that pay dividends, and she received a 4% dividend each year, that's $20,000 a year. So if that's enough for her to live off, that's great. She doesn't have to sell her stocks because she can just live off the dividend part, if that makes sense. So her 500,000 just keeps growing and growing, and she just kind of clips the 20,000 in dividends each year that it pays, and she can live off that absolutely fine. So she doesn't have to dig into her 500,000. If that wasn't enough and you actually had to maybe do a combination of both. So you had the 20,000 from the dividends, but then you also maybe you had to take out 10,000 by selling your shares, then yes, you're going to reduce that amount, that 500,000 each year. So there is actually a really good rule that most kind of financial advisors and financial planners use. And it's called this rule of 4%. And it's the idea that if you withdraw no more than 4% of your portfolio each year, your money should last about 30 years. So if you decided, you know what, I think I can live off 40,000 a year when I'm in retirement, then kind of back solving that, you'd need $1 million when you retire. So 4% for 30 years on $1 million is about 40,000 a year to live off. So if you're like, you know what, actually 40,000, I can't live off that, I need 60,000, then when you retire, you'd need 1.5 million. So it's called this like rule of 4%. 4% of 1.5 million is 60,000. So if you can live off that per year, that's what you need when you reach retirement, is 1.5 million. And just to be clear, you are not taking 4% out from when you first start investing. You are taking 4% out when you retire at 65. Yeah. Just to be clear.
Thank you so much for listening to The Curve Weekly. Make sure you hit subscribe or follow wherever you're listening so you're always up to date with the latest finance and investing news.
And feel free to leave a comment to let us know what you thought about this episode, because we would love your feedback.
We've got new Curve Weekly episodes for you to listen to every Monday, but until then, listen to Erasing the Curve. These are our in-depth podcast episodes where we chat about all things money.
We're also around all week on socials if you're hungry for more Curve content, and all the links are in this podcast's show notes. We hope you have a great week, and we'll catch you for the next episode of The Curve Weekly on Monday.
Okay, quickly, The Curve was created to empower and educate you about investing, but we are not financial advisors.
Our platform exists for educational purposes only, and it doesn't provide personalized investing advice for your individual needs and should not be relied upon to make an investment or financial decision.
And always remember to do your own research before making any investment or financial decision.
We're here for any knowledge and support you need, but the final call is always yours.
And thanks for being here.
You got this.
Yeah, we know you got this.